All right. Today is Tuesday, March 23rd, and this is a post-market review for the stock market activities today. Before we entered the week, we knew that we had oversold conditions in the TLT and bonds in general. So our expectations were that at some point soon we will see a short covering rally taking place in the TLT, and that would result in yields moderating and diving lower. So we saw yields since yesterday giving up some of the gains, still elevated levels, but well off the highs, and that gave the Nasdaq the green light to rally yesterday. But we saw a bad closing at the end of the day, and we know that nothing changed regarding the drivers behind the rise in Treasury yields. We are talking about inflation expectations. Well, today we had a major development across the market, and we are throwing a wild card in the mix. With that being said, this card was also expected to happen. We talked about fading the reopening stocks due to the unpredictability of reopening from COVID. Investors pushed these stocks to surpass their pre-pandemic highs, meaning that there was some sort of euphoria in pushing these stocks higher, betting on the best case scenario of a clean, flush reopening. We started to hear about European countries locking down once again due to the surge of the quote-unquote fourth wave of the COVID-19 virus. Today, we saw more countries closing down, and that threw cold water on this whole reopening rally, that it was overdone and premature. But it is also a check for the rise in yields, because the rise in yields is driven by the rise of inflation expectations. Well, if we're going to take longer to reopen, then inflation expectations will remain high, but they will be tempered and delayed because the reopening will also be delayed. And right away, you saw crude oil prices crashing down, and we saw yields being driven lower once again. Now, all of these conditions, one would assume, would help the continuation of the bounce in the Nasdaq, the technology stocks, the high growth, high multiple stocks. But the mystery of the day is that that did not happen. In addition, we heard the testimony from the Federal Reserve Chairman Jerome Powell and the Treasury Secretary Janet Yellen. And once again, they doubled down on the same stance of yields are rising for the good reasons, and inflation is expected to rise higher, but it will be transitory. And if it is not transitory, then we have quote-unquote the tools to deal with that. And the problem is, and perhaps this is the reasoning behind the underperformance today from the Nasdaq and technology stocks, even though we saw favorable conditions in terms of lower yields today. The explanation goes as the following, that the cure is worse than the illness. Meaning, if the illness is high inflation, and then inflation will rise out of control, causing yields to rise higher, then what does Jerome Powell and the Federal Reserve mean by quote-unquote tools? Because the only effective remedy to combat the rise of inflation, if it gets out of hand, is to raise interest rates. And we know that rising interest rates will crash the market, and therefore the cure is worse than the illness. And my expectations are that either the market is now absorbing the cure is worse than the illness outlook, or today's reaction in the market was just a knee-jerk reaction. And in the coming days, the market will assess the situation and comb through the move today and pick the next direction. And if the current conditions persist of driving yields lower and inflation expectations tamed due to the rise of COVID-19 infections in Europe and across the world, then the expectations are that the market will take a moment, comb through the move, and then pick technology and the Nasdaq as the winner and push these names higher once again. And we saw some of that happening today with the so-called reopening trade of travel, airlines, casinos, hotels getting smashed. Meanwhile, the so-called stay-at-home stocks of Zoom, Peloton, and Netflix managed to outperform. So we have the challenge here. Did the market just realize that the cure is worse than the illness? Or did the market do a knee-jerk reaction and it will comb through the move in the next few days? We will try to answer this question in our coverage tonight. But for now, I gotta move on because I have a market to cover. And here we go. The Dow closing in the red, down by 308.05 points, or a decline of 0.94%. The Nasdaq down 149.84 points, or a decline of 1.12%. The S&P 500 closing in the red, down by 30.07 points, or a decline of 0.76%. And what about the sector's performance of the day? Leading the pack, and the only sector closing in the green, capturing the gold, silver, and bronze metals, utilities. Meanwhile, the laggards of the day led by energy, materials, and industrials. The take here is the following. Utilities acted as expected. When we see yields diving lower, that should benefit utilities. But the mystery remains, why didn't technology act in the same manner that utilities took today? Perhaps we have a lagging reaction, or like I said in the beginning, the market realized that the cure is worse than the illness. Moving on to the futures market performance, we saw a spike in the US dollar, finally closing above 92 once and for all, and decisively so, by the way. That in turn added pressure on futures, specifically on crude oil futures, the WTI and Brent, down over 6% apiece. Massive decline, and of course add to that the pessimism of this whole reopening move due to the new fresh rounds of lockdowns over in Europe. Now the dip in oil will be bought, but you gotta let the move take its course. If you must participate in buying the dip in energy or financials or any of these names, then you have to do it via call options because your risk is limited. But the better move is, in buying the dip in these names, is to wait till the move finishes its course. Moving on to softs futures, lumber, another day in the green. Meanwhile, massive declines here for the rest, led by OJ, coca, coffee, cotton, and sugar futures. And by the way, let's answer the question from yesterday. One of the viewers asked, why do you call lumber, copper, and grains the axis of inflation in the futures market, but you're leaving out crude oil? The reason is that the surge in the prices of crude oil is not supported by actual demand. The world is still under a lockdown in one form or another for the most part, and therefore the rise of crude oil prices was done prematurely due to inflation expectations, meaning that traders and investors were buying crude oil ahead of time in anticipation of a clean, flush reopening that will cause a massive surge in inflation expectations. Now we are throwing cold water on these expectations via new lockdowns in Europe, and therefore crude oil is suffering today. That doesn't mean that the outlook in crude oil has changed. The outlook remains for higher prices because sooner or later we will reopen, absent of a black swan event such as a new variant that is resistant to the current vaccines. Meanwhile, when it comes to lumber, copper, and grains, there is a legitimate shortage of supply. The demand is surpassing the supply, and meeting the demand requires ramping up production and supply. And in certain cases, in lumber, copper, grains, that cannot be done easily. You cannot start new mines of copper instantly. That will take time. Likewise, we have certain phenomena when it comes to grains, like El Niño in South America and the locust invasion in Africa, in Asia, in other places. That is causing disturbance of production, and there is a shortage. Therefore, supply might not be able to catch up with demand for this season, and therefore you're seeing prices of grains surging higher. Likewise, when it comes to lumber, you're not going to go with a chainsaw and start chopping the forest. The supply is very regulated, and the demand is surpassing the supply rapidly before suppliers are even able to process new orders and stock up inventories. And therefore, there is a legitimate push in inflation in these three futures. Crude oil, even if we see demand surging higher after the reopening, increasing the supply is not a problem. It could be a problem for the United States because the current administration is anti-fracking and anti-big oil, but Saudi Arabia, Russia, other OPEC members will be able to ramp up production when needed. Back to the coverage for the futures market. What's going on here with metals? Once again, the dollar moving higher, and that would add pressure on metals futures as expected. Losses across the board led by copper, silver, platinum, gold, and palladium. What about meats? Gains across the board led by lean hogs, live cattle, both scoring over 1% gains today. Meanwhile, we saw modest gains for feeder cattle futures. What about grains? A rebound day across the board with gains led by oats, wheat, and soybean oil futures. Meanwhile, the laggard in grains futures, canola, down about 2% or so. Moving on to the big casino, the options market, and let's see what's going on here. The steamy money is not showing up yet, and I have a piece during the headlines of the day that could explain the absence of the participation from retail traders in the options market. But for now, at number 1, leading the pack, with about 1.1 million contracts, Apple, about 70% of those were calls. At number 2, Tesla, with a little over 500,000 contracts, about 54% of those were calls. And at number 3, an interesting choice, Altria Group, the ticker MO. This is for tobacco. We saw a technical breakout for this name, and it is a value name. It is a name that traditionally would benefit from the rise of inflation. And in this case, we saw over 500,000 contracts trading for the name, and about 98% of those were calls. Moving on to the interesting trades, the unusual activities that took place in the options market today. Starting with the ticker IWM for, you guessed it, the IWM. Small caps, we saw a massive decline today, and we have a breakdown, technical breakdown, happening in the IWM right now. And they are betting for more declines to come here for small caps by buying the 173 puts expiration date June 18th, with expectations that the IWM will decline over 20%. By then, they paid about $2.10 a piece to enter this trade, which brought the total all the way to $4.2 million. What about the trade for the ticker LI, Auto? They're making a bearish bet here by buying the 25 puts expiration date May 21st, with expectations that the name will decline over 5% by then, and they paid about $2.15 a piece to enter this trade, bringing the total all the way to $3.8 million. What about the ticker for Apple, AAPL? They're making a bullish bid here, buying the 133 calls expiration date April 23rd, with expectations that the name will gain over 8.5% by then. They paid about $1 a piece to enter this trade, which brought the total all the way to $1 million. And here is the opposite trade, making a bearish bet against the Qs, the Nasdaq, by buying the 288 puts expiration date April 9th, with expectations that the name will decline over 9% by then, and they paid about $1 a piece to enter this trade, which brought the total all the way to $1 million. What about the ticker MU for Micron Technologies? They're making a bearish bet here by buying the 77.5 puts expiration date May 21st, with expectations that the name will decline over 9% by then. They paid about $2.75 a piece to enter the trade, bringing the total all the way to $1.3 million. Continuing with interesting trades. What about the ticker LASR? This is for Knight Semiconductors, a Canadian company. The name got whacked today, down almost 10% for the session, and they're betting for more pain to come by buying the 30 puts expiration date May 21st, with expectations that the name will decline over 7% by then. They paid about $2.65 a piece to enter the trade, which brought the total all the way to about $1 million. And here is the last trade of the day for the ticker VIAC, Viacom. You know, Viacom became a meme stock. And we covered the chart about a week ago, and I told you if the name trades at 100 or above, I would be shorting with both hands. We already shorted the name, and it dropped 10%, and we scored massive gains. Yesterday, the name snapped right back to 100, so I added to the position, and today the name was down over 10% again. And the reason is because the executives of Viacom are doing the right thing, and they are milking the mania for all of its worth by issuing and dumping more stock. So somebody's making a big bet here that we will see more declines to come for Viacom by buying the 85 puts expiration date May 21st, with expectations that the name will decline over 7% by then. They paid about $6.15 a piece to enter the trade, which brought the total all the way to $2.2 million. Moving on to the headlines that shape the day, starting with macro news. The housing bubble is popping right before our eyes. It could be the initial pop, then the reflation, and then the final pop. But for now, we know that the bubble is popping, and there will be lots of victims. New home sales plunge in February amid harsh winter weather. The Department of Commerce reported sales fell 18.2% to an annualized rate of 775,000 units, up 8.2% year over year. This is the sharpest monthly decline since July 2013. And this reading missed economists' expectations, which were sales falling 6.5% to about 875,000 units, meaning that we missed expectations by a lot. And this is an illustration, by the way, for the fragility of this housing bubble. The slightest rise in interest rates will make homes inaccessible to the majority of households. Meanwhile, the donkeys who stampeded to buy homes last year at bubble prices just to lock in the low mortgage rate, well, you're financing an overpriced home. And what's going to happen now is that the value of your property will go down. Meanwhile, your interest rate for the mortgage will continue to go higher and higher. We will see lots of victims if this is the scenario we're heading to. And by the way, the outlook is grim. It's not good, because here it is. The move we saw in the 30-year Treasury bonds is the steepest decline year to date ever in history, meaning that if history is correct, we will see the outlook and the trajectory for the 30-year bonds much, much lower. And remember, bonds have an inverse relationship. Price to yields. When prices dive lower, yields surge higher. So looking at this chart, this is basically telling you that the move in Treasury yields in the 30-year specifically is the sharpest move year to date in history. And if history is a guide, yields might take a break, but they are on the trajectory of a historic run. And of course, this is all done by design, by the mania, that tsunami of liquidity by the Federal Reserve, creating inflation all over the place and not achieving the quote-unquote results and goals in terms of the economic recovery. Trillions of dollars were printed out of thin air and spent into the economy, and yet we have no results to show for. And the only thing that we know for certain that this tsunami of liquidity has achieved is making the rich richer. Thanks to a strong stock market and real estate gains, the wealthiest 1% of United States households saw their net worth rise by $4 trillion in 2020. And that is a total of 35% of the extra wealth generated nationwide during 2020. Expand that to the top 10% of households, and the share climbs to 70%. Meaning that all of what the Federal Reserve has achieved is, and this is their secret mandate, by the way, to make the rich richer. They can tell us all they want that their mandate is maximum employment and controlling inflation and all of that bullshit. But the real mandate is, because actions speak louder than words, their secret mandate is to prop up, preserve, and inflate the assets of the wealthy, stocks and real estate, thus making the rich richer and the poor poorer, and creating the biggest wealth inequality gap in history. This is not capitalism. This is gangsterism. This is a selected few in a big club throwing away the future of this country to score immediate gains and make themselves richer on the expense of the future of this country and the next generations. And here is to the deflationary crowd. What do you think happens when the government print money out of thin air and they hand it to the people? Well, they're going to spend it in the economy, impulsively so. And as expected, you see the credit card consumer spending surged significantly higher right after the 1,400 stimmy checks started hitting bank accounts. Immediately, all of this excess supply of money doesn't disappear in a black hole and all of a sudden we have deflation. This excess money supply will show up in the form of inflation. Simple as that. You don't eat 20 cheeseburgers per day and expect to lose weight. But if that didn't convince you and you thought the $1 trillion in spending is nothing, wait, because there is more. This summer, the U.S. will embark on its first nationwide experiment with child allowances. From July until the end of the year, millions of parents will receive monthly checks of up to $300 per child under 6 and $250 for those under 18. And of course, the money to pay for all of this will be printed out of thin air and added to the national debt and the budget deficit. What does that mean? It means that your taxes will go up eventually, whether you like it or not. We're not talking by a little, like, oh, taxes are going higher by 5%, big deal. No, taxes are going up by 15, 20, 30% because it is impossible to close this massive hole we created without a massive increase in taxation. And once again, all of this spending, all of this money supply is resulting in more and more inflation. Global steel output rises 4.1% year on year in February. The World Steel Association says, and even with outputs rising, the inflation in steel prices continues to grow hotter and hotter and hotter because the demand is out of control, even with a surge in supply that is not enough to keep up with the surge in demand. That is, of course, raising the fears of inflation and causing investors in the bond market to dump bonds. The outcome is a surge in treasury yields. But who was doing the selling here? We know banks did about 80 billion or so last week of selling, but perhaps foreign buyers are now leading the selling. Japanese investors seem to have been on a buyer's strike of U.S. treasuries lately, but the U.S. 10-year are now offering the highest yield since 2015 after adjusting for cost of rolling 3 months FX hedge. So we will see if the Japanese will resume buying bonds again. But why would they? Because they know that with all the mania and spending we're doing, the likelihood is that inflation will rise higher and treasury yields will continue to rise higher and higher, meaning that there is no incentive to start buying right now if the expectations are the yields will continue to rise higher and higher. And the response for many central banks across the world is to start tightening monetary policy to tame inflation expectations. They are getting the memo. Bank of Canada ending some market liquidity crisis programs signals it is preparing to slow the pace of overall large-scale asset purchasing program. So a lot of central banks across the globe are taking action to curb the rise of inflation because all of this cocaine operation of liquidity is not needed anymore. It is excessive. But the big question is, how are the maniacs in our Federal Reserve handling the situation? Are they acting like the Bank of Canada and reducing some of the assets purchasing programs? Of course not. Fed's brain dead. Climate change is already imposing substantial economic costs. These are the priorities of the Federal Reserve these days. Inflation, that's no problem. It's never going to get out of hand because it is transitory. And if it is not transitory, then we got the tools, bro. Now, what about climate change? You have no tools for that? Surprise, surprise. You're a central bank after all. What are you going to do to stop climate change? Stop printing? You know, the heat from the printer? That adds to global warming tremendously. And we know when you let the Federal Reserve's personalities loose and they start doing interviews, the goal is to do a synchronized propaganda. But the problem is that we're talking about individuals and sometimes they slip. And in the case of, say, St. Louis President James Bullard, he's always high on hash. And he slips and he tells the truth and says outlandish statements that sometimes freak out the market. And today we heard some of those statements, not from Bullard though, but from Dallas Fed President Kaplan. We talked about Kaplan in this program before. Him and his famous $25,000 leather chair. Oh, he loves that chair. He takes pictures with it all the time. And rumor has it that he tried to mate the chair at some point, but he received a Me Too complaint from PR. Regardless, the man loves to sit, and he loves to sit like an emperor, with his hands spread, legs crossed. Nobody sits better than Mr. Kaplan of the Dallas Federal Reserve. But the problem is that Mr. Kaplan slipped today and issued some hawkish, aka honest, statements.
I want to start off right where the at the heart of the market's concerns here. I want to know if you share the inflation concerns that have been expressed by some in the market. We noticed that Chair Powell doesn't mention the word inflation in his testimony today. Does that mean it's not a concern?
The interview hasn't even started, and he's already but. Holy shit, where did this question come from? And notice his propaganda answer for the question. He's repeating and parroting the same line from Jerome Powell. Oh, inflation is not a big deal, and even if it happens, it is just transitory. And even if it is transitory, we get the tools, bro.
I think we're wise to pay attention to those concerns and be vigilant about them. Having said that, my own base case is that we'll see a surge in prices this year. A lot of that'll be due to supply outages related to COVID, supply-demand issues, other issues, metals, semiconductors, wood products, and so on. But I do believe that a lot of those supply-demand issues will get worked out over the next year, and that's what I'm hearing from companies in those industries. And I still believe technology-enabled disruption is a powerful force, so that inflation in 2022 will settle down a bit, and we'll still be running at or a little bit above 2%. Now, having said that, that's a forecast, it's a base case, and I think we're wise at the Fed, and I intend to be very vigilant about it and be watching this very, very carefully.
So everything started hunky-dory with the Kaplan interview. Everything is going on according to plan, the same propaganda from Papa Jerome. But here is where things got a little more interesting, and out of script, shall we say, because Kaplan admitted that he was one of those dots that indicated that interest rates should rise higher earlier than the consensus of the Federal Reserve by the year 2023. Kaplan believes that by 2022, rates should be raised higher.
President Kaplan, I know this sounds weird, but where's your dot? Are you a 2022 guy in terms of raising rates?
There were some dots starting increases in 2022, and I'm one of those dots. Yes.
And you see the smirk on his face? That's basically saying, yeah, Jerome is kind of crazy, and we're going to raise interest rates a lot sooner than you people expect. Don't believe the Federal Reserve. It was me who voted that we should raise interest rates sooner than Jerome wants them to be raised. And right away, CNBC anchors, like a bunch of babies, started to get excited, their panties all wet. They can't believe that they just made breaking news, exclusive news, controversial statement by Dallas Fed President Kaplan.
Fascinating. And let me ask you about removing accommodation. And Joe, I'm sorry if you wanted to follow up, but I'll just get this one out there.
I feel like I stole your stuff already, but when I get you to say $3 trillion, it's got $3 trillion. That sounds after 1.9. We're like desensitized, President Kaplan. I think you need to talk to your colleagues, and you still got a relationship with Chair Yellen, Secretary Yellen?
The problem, however, is that when Kaplan was asked, could raising interest rates happens even sooner than you have outlined, meaning this year in 2021? And all of a sudden Kaplan started acting dumb like he doesn't know and weaseled his way out of answering the question.
Might that be this year, President Kaplan?
I'm going to stay away, as you know, Steve, from calendar estimates. Our benchmarks are not calendar-based, they're outcome-based. And so I'm not going to prejudge when we're going to make substantial further progress. But as I see that test being met in my own mind, I'll be arguing for taking action. But I don't want to predict exactly when in the calendar that will be, because truth is, I don't know.
And this statement is very dangerous, by the way, because what he's saying is, I don't know, I'll just wait for inflation to get out of hand first and then react. And this is what we mean by a reactive Fed rather than proactive, meaning that they're going to wait for the disaster to happen and then intervene after the damage has been already done. This is a very dangerous stance by the Federal Reserve.
I've been one that's been saying for most of this year, I would expect the 10-year to back up further from here. And that means 1.75%, 2%. In February of 2020, the 10-year Treasury was 1.75% to 2%. I don't see why, as we recover, that the 10-year rate won't back up further. I think that'll be a healthy signal, not an alarming signal, but a healthy signal, and not one that I would be an advocate of getting in the way of.
And to conclude, Kaplan went back to the playbook from the Federal Reserve propaganda manual by saying that, yeah, yields are rising, but they're rising for the good reasons, and we should celebrate that yields are rising higher, meaning that the Federal Reserve once again is giving you the permission to short the hell out of the NASDAQ and the mania names, because they're not going to do anything about the rise in Treasury yields until pain has been already inflicted on the market. So your hope here as a bull for the NASDAQ is that COVID-19 will get out of hand once again and we will delay the reopening, because that would push yields lower. Absent of that, the Federal Reserve will do nothing for now to curb the rise of Treasury yields. And here are the statements we received today from the Federal Reserve Chairman Jerome Powell and Janet Yellen, the Treasury Secretary, testimony today in Washington, D.C. Secretary Yellen says that asset valuations are high by historical measures, but we're not going to do anything about it. So what? We got a bubble. Who doesn't love bubbles? Have you tried taking a bubble bath? It's beautiful. And then we heard the same bullshit from Jerome Powell. During joint testimony with Treasury Secretary Yellen, Fed Chair Jerome Powell admits the central bank is seeing some inflation pressure. Quote unquote, there will be modest upward pressure and they will not be persistent. We do have those tools. Here we go with Tool Man again. We have those tools and we will use them. He's talking about his tools as if they were magic wands that will make inflation disappear overnight. Meanwhile, what he's talking about is, by saying tools, he's talking about raising interest rates. And here we go again, back to the cure is worse than the illness. If you thought inflation is bad, well, the remedy is not pretty either. It will freak out the market more than the illness of inflation itself. More crap from Jerome. Fed Chair Jerome Powell said prices would rise this year as the pandemic recedes, but he played down the risk that this would spur unwanted inflation. Once again, arrogance, recklessness, lack of responsibility, ignoring the facts. But perhaps Jerome is lucky because he has an unexpected partner to help him in this cause. And this partner is COVID-19. UK Prime Minister Johnson to keep all borders measures under review and will bring in new measures if necessary, meaning extending the lockdown. So down goes Britain. Who's next? Here is the Netherlands, or Holland. The lockdown in the Netherlands, including a nighttime curfew, will be extended until April 20, Prime Minister Mark Rutte told reporters. And here is the last bit of macro news. You know, with all this misery of lockdowns, and expecting the unexpected, and the mania going on with our leaders, our central bankers, we've been drinking a lot. But here it is, for the first time in a year since COVID-19 began spreading across the United States, forcing Americans to stay at home. Retail alcohol sales have fallen. Of course, alcohol is not enough to deal with this misery. Bring out the elephant tranquilizers, because this pain is deep. Moving on to sentiment news, starting with the stimmy checks. What's going on with the stimmy maniacs? Why are they not showing up in the market? Why are they not buying call options? Putting their blindfolds on, stampeding Naruto style, buying call options in Tesla, NEO, Plug Power. What's going on here? Here it is. This time around, there are signs that the latest $1,400 checks are set to finance traditional pursuits from beach vacations to family visits. Meaning that this time around, the Robin Hoodiots so far are deciding to use the stimmy checks wisely by spending that check in the real world, not the digital world, and gambling in the casino. And we saw call options volume retreated despite the latest stimulus check. Are they waiting for a better price, a better entry opportunity? Perhaps, but for now they're absent. And you saw the credit card spending data, meaning that they are spending in the real world. So the retail trader, for once, is acting smart. What about the institutionals? We have the opposite picture. The institutionals are now the donkey leaders. Mega flow. The Qs notches the largest one-day inflow since, you guessed it, 2000, right before the dot-com crash. They poured in more money in a single day, last Monday, than any day in history since the year 2000. And today the market went down. So obviously a very wise decision by these morons. And these are the people who are supposed to be, quote unquote, the experts, the professionals. It's not their money, so why not roll the dice with it and get richer, collect more fees? And they're buying the market at the highest median price to revenue ratio of the S&P 500 ever in history, surpassing the dot-com mania. Who cares about valuations anymore? We got a lot of cash. Just throw the cash and burn it in the chimney, because who cares? We got a lot of cash and we don't know what to do with. We got to deploy the cash anyways, so we're just going to dump it in stocks, buying at the most insane valuations ever. Who cares? Who cares? It's not our money. It's pensioners, retirees, school teachers. Who cares about these bums anyways? And here's the last bit of sentiment news. Bond proxy. Tech stocks and the 5-year treasury yield are the most negatively correlated since, you guessed it, 1999. What more proof do you need to understand and realize that the mania is over? Party's over. Time to go home. Time to use the stimmy in the real world, going on vacations, going to the beach, not in the digital world where you're gambling on Robinhood and buying NFTs. It's time to go back to the real world. Moving on to corporate-specific news, starting with, you guessed it, the souffle, Tesla. And the souffle is in a lot of trouble. When it rains, it pours. Here is from the New York Times. Tesla's autopilot technology faces fresh scrutiny. Federal regulators are investigating 23 recent accidents in which drivers were or may have been using automatic steering and braking system. And here is a picture from the accident in question where Tesla Model S had a fatal collision. I mean, there is no way you can survive this kind of accident. The car is pretty much flattened and the person died using the autopilot system of Tesla. And rumor has it, to remedy the situation, Tesla will announce new products. They will start making and selling solar coffins from Tesla. Just in case you die, you also die in your cult coffin. And by the way, the coffin has an option to be bought as an NFT. So should we add another trillion to Tesla's valuation due to coffin optimism? But the competition is getting hotter and hotter for the souffle. Porsche supports VW's $87 billion overhaul to turn the German industrial giant into an electric car and software leader, and sees its recent stock surge as validation. And some of you asked me about VW and Porsche's stock in particular. And the answer is, so long as VW stock is surging higher, Porsche's stock will continue to go higher and higher. And from what I know, my own anecdotal evidence, Porsches are selling like hotcakes. They're all over the place. And all of these Bitcoin millionaires and Tesla millionaires, all of these Robinhoodians who made a lot of money last year, some of them are smart. And they're using the money to buy actual stuff and not just sit on paper gains and wait for them to go to the moon, bro. They're taking the money out and they're buying some toys. And therefore, Porsche sales are surging higher. But leave it to Tesla witch Cathie Wood and ARK Invest. In the report, they shit on VW and they say that they will never achieve the success of Tesla and they don't deserve a multiple premium, just like the insane multiple premium we're giving to Tesla, because VW has a quote-unquote linear expansion. Meanwhile, Tesla has quote-unquote exponential expansion. And once again, these are the trickeries that the cult leaders over at ARK Invest use, the likes of the Monte Carlo model, throwing buzzwords to give you the illusion that their trash research is legitimate and based on science. Meanwhile, we know that the report is based on a tip by the Holy Spirit. But Tesla witch Cathie Wood should be careful, because sometimes the devil can impersonate the Holy Spirit. Moving on to Microsoft, we saw Microsoft stock surging higher today on the heels of this announcement. Microsoft is in talks to acquire Discord, a video game chat community, for more than $10 billion, according to people familiar with the matter. Now, Microsoft had a decent run of luck in their recent acquisitions, whether it's LinkedIn, GitHub, or many others. So perhaps this is a good move by Microsoft because they already have Xbox, and this will integrate well with the Xbox platform. And once again, if Discord was IPOing via SPAC, the maniacs in the stock market will value the company at $50 billion. So Microsoft is getting a deal here, assuming that the deal will go through, by the way. And what about Tinder, Match.com, and Lyft? We got a twofer here. Tinder will let users gift Lyft rides to their dates through a partnership, or new partnership rather. So apparently now you can buy a girl's profile on Tinder as an NFT, and then you can buy a digital ride for your digital date and pretend that she's coming over at your place. And then you can serve her some of that digital alcohol. Perhaps this is the reason behind the decrease in alcohol sales in the US this year. We now drink digitally. What about Sega? Sega's adorable Astro City mini arcade is coming to the US. Should we pop Sega stock another 20% higher on retro optimism? And what about AstraZeneca, the vaccine? What a disaster this situation is. I told you that the confidence is gone from the population regarding this vaccine. People are not going to volunteer to take the vaccine if it is from AstraZeneca. This is a major problem, a huge PR headache for the company because they've been validated by the regulators, but as I told you, the fears and the suspicions are only going to go higher by the population that are being targeted as vaccine subjects. And this is a big problem considering what's going on with the lockdowns and the fourth wave of COVID-19 infections over in Europe. But perhaps there is hope here because we have some good news from Pfizer, because Pfizer is developing a pill for COVID-19. The experimental drug inhibits enzymes essential for replication, which is how many successful antiviral, HIV, and hepatitis C drugs work. Now, here is the take from this piece of news. Number one, on one hand, it will hinder the progress of vaccination because a lot of people who are waiting on the sideline, debating whether to take the vaccine or not, will now say, well, why not just wait for the pill when it comes out? Specifically for younger demographics. On the other hand, the anticipation of an easier treatment, more accessible, easier distribution in the form of pills will restart the so-called reopening optimism, pushing yields higher once again. So therefore, the advice is, for this week at least, hold your horses. Don't make premature decisions because you could assume right now that the COVID situation is getting out of hand, yields will go down, and the technology sector will make a comeback. Let's start buying Zoom and Peloton and the stay-at-home names. And next thing you know, you get the news that Pfizer is now testing the pill and it is effective. And now we have the reopening optimism surging again. This is becoming a very dangerous and jittery ride. So my advice is stick to your guns. Wait. Don't make any premature decisions. If you are pro the NASDAQ, pro the technology trade, then stick to that. If you're like me, pro the inflationary trade of financials, energy, materials, and industrials, then also stick to your guns. Do not jump from one position to the other until more clarity appears, because you will get burned making premature decisions. Moving on to the heat map analysis, let's see what happened today. There were multiple dynamics dictating the movement in the market today. Number one, the retreat in Treasury yields. That impacted financials negatively, but the mystery remains, why didn't technology, specifically the mania names, react positively to the decline in Treasury yields? Is it a matter of a lagging reaction combing through the movement today before pumping these names higher? Or is the market realizing that one way or the other, yields will resume the movement higher because the cure is worse than the illness? One way or the other, interest rates will rise higher. We should get the answer tomorrow. We have another dynamic that dictated the market's move today, and it is the decline of crude oil prices. and right away we saw oil stocks declining significantly, with exception to the two giants Exxon and Chevron. Exxon down about 1.2% today, meanwhile Chevron down a little over half a percentage point. And the reason behind the outperformance of Exxon and Chevron today, even though we saw a massive red day in energy stocks, is due to the uneven recovery between the US and the EU. Chevron and Exxon are dependent on the consumption in the US, not the EU, and therefore the impact of the declines that we saw in crude oil prices is minimal when it comes to Chevron and Exxon. But when you take a look at a name like British Petroleum, for example, that is down over 5%. Likewise, Royal Dutch was down about 5% as well. And we have another dynamic here that dictated the move in the market today, which is the surge of new infections of COVID-19, and that is throwing cold water on the reopening trade. We saw massive declines in airlines, casinos, hotels, cruises, all getting whacked severely today. Meanwhile, the stay-at-home stocks, Zoom, Peloton, Netflix, managed to outperform. My take is the action in utilities is the one to trust because we saw yields retreating and diving lower. That is supposed to help utilities and technology. And if utilities traded higher today, then utilities are saying trust the move in treasury yields. They went lower, so the Nasdaq should outperform and the bounce in technology names should resume, at least for the short term. Let the move run its course. As I said during the weekend's video, we will see a short covering rally in the TLT and yields will go lower, driving inflationary stocks lower and technology stocks higher. And I told you that the dip in the inflationary trade of financials, industrials, energy is to buy, but you gotta let it run its course. And the pop in technology and the momentum names is to fade, but you gotta let the move run its course too, because nothing has changed regarding the Federal Reserve's stand about the rise in treasury yields. They're not gonna do anything about it. They believe that yields are rising for the good reasons, and there is no problem whatsoever. They're only gonna react if the movement in yields get out of control. And this is exactly what's going to happen next. For now, there are two headwinds against yields. Number one, the short covering rally in the TLT, and now we have the resurgence of COVID-19 infections. That is the wild card, and it could reshape the destination of the market. But once again, I remind you, be careful of jumping the gun one way or the other, because next thing you know, you buy the dip in technology, yields continue to go lower, and then we have an announcement that we have a new vaccine, a new pill, a new treatment. And here we go again with vaccine optimism, and we're going to play the yo-yo game back and forth, shifting from one sector to the other based on the flow of news. So your strategy should stick to your own macro outlook. What do you see in the next few months? High inflation, low inflation, soft reopening, hard reopening? What about the spending the government is about to make, etc., etc.? Now, let's check on the themes in the market, starting with the nostalgia stocks, aka the reopening stocks. I have been telling you since last week that I am starting to become bearish against these reopening stocks because number one, they went out of whack ahead of themselves in the move higher, and number two, there are no guarantees that the reopening will go as expected. The story about COVID is not over yet. And right away, you saw massive declines across the board. Whether we're talking about restaurants, Cheesecake Factory, Live Nation, casinos, MGM Grand, cruises, Royal Caribbean, Hilton, Southwest, massive declines across the board. What about the inflationary trade? Mixed picture, but mostly negative. Yields going lower. We see losses in banks, industrials, materials, the infrastructure names, all suffering losses today. But did that translate into gains for the de-inflationary trade? Not really. We saw declines across the board for names like Snapchat, DoorDash, Square, Tesla, but modest gains here, specifically for the names related to the stay-at-home trade. We're talking about Zoom, Peloton, up over 3% apiece. We have DocuSign slightly in the green. So the market is still processing the flow of news, and it did not make its final decision yet. Moving on to the charts analysis. starting with the 15 minutes chart of the SPY. We talked about the bear flag formation that is supposed to take us lower. We talked about the support of 391, that it is a weak support because the bear flag force will be strong enough to crack below it. So we are looking for 386 for support, and if we continue to see profit taking in financials, industrials, materials, and energy names due to the rise in treasury yields, and especially if that comes in combination with a rise in the US dollar, we will see significant losses here, lots of profit taking, and that would drive the SPY down. But the balancing act will be from technology, because the assumption here, now that yields are retreating, technology should outperform. So there is a balancing act here between the gains in technology, the bounce in technology, and between the profit taking and sell-off in energy, financials, and the rest of the cyclical sectors. What about the daily chart for the S&P 500, the continuous contract? We don't have significant changes today. For now, the destination remains 3,960. That is the resistance. And the support at 3,862. We have a negative divergence still in the RSI, so slightly tilted to the weaker side. Moving on to the Qs. What do we see here? We talked about the Qs being in purgatory, in the ping pong game, back and forth between 313 and 323. And the longer the Qs will wait in this area without making a decision between 323 and 313, the gravity is on the side of 313, meaning that the path of least resistance is lower. So the Qs should make a decision very soon to crack above the resistance level of 323 and turn it into support. Otherwise, not making that move will eventually lead to the Qs falling back to the center of gravity in the chart, 313. We have a gap that we should be able to close if we dive lower. And what about the continuous contract of the Qs? In the 15 minutes chart, you are seeing a topping saucer formation or a head and shoulder formation. But it is always helpful to see the big picture because the longer range charts speak the loudest. And in this case, we have a daily chart versus a 15 minutes chart. In the daily chart, we see a reverse head and shoulder formation, but the resistance remains the top of the reversal candle, which coincides with the purple trend line that you see on the screen. That will still be a very tough point to cross. So if you are waiting to short the Nasdaq or the technology stocks in general, absent of a reversal candle, you should wait till the Qs reach the purple trend line and see how the chart is going to react at that point. And of course, we will watch the reaction hand in hand with what yields are going to do at that point. Moving on to the IWM 15 minutes chart. We saw the double top formation followed by a series of bear flags, leading us lower and lower and lower. We have now cracked below the support level of 218. Very negative closing here for the IWM. We know GameStop reported after the bell, and last time I checked, the name is down double digits, so that should add more pain for the IWM. And how do you spot a short-term bottom, by the way? You should see something as an ABC formation, a pause in the bear flag formations. Here is a daily chart. Bat formation, loss of momentum in the RSI, MACD, signaling more pain to come here for the IWM. And we are looking for 204, 205. That would be a good area of support to bounce from. And what about the Dixie? Here we go, the dollar index cracking above 92. It's been consolidating just beneath 92. And we talked about the charting behavior of consolidating just below a certain resistance level. It means that eventually you will be able to crack above it. This is exactly what happened with the dollar today. And of course, that would have impact on metals, specifically gold. We talked about gold and the correlation between gold and the US dollar. If the US dollar cracks above 92, then rationally, gold will not be able to crack above 1740, which is the resistance level we're eyeing right now. But remember, gold is being dictated by three factors. Number one, the US dollar. The move higher today in the US dollar was negative for gold. But number two, treasury yields. When treasury yields go higher, gold loses value. Today we saw yields diving lower. That is good for gold. And lastly, we have Bitcoin. And Bitcoin pretty much closed flat, back and forth, up and down, small losses, and that is also good for gold. So two factors reacted positively for gold, but the main one, the dollar index, acted negatively. All in all, we did not see a massive loss here for gold, just facing a normal level of resistance, meaning if we continue to see yields diving lower tomorrow and beyond, perhaps gold will be able to pull a rally hand in hand with the US dollar going higher. It's rare, but it has happened before. What about Bitcoin? What's going on here? We talked about the bear flag formation, and it is starting to play to the downside. Now, we have not broken the series of higher highs and higher lows. Until and unless we do that, the picture remains positive for Bitcoin, but starting to become a little concerning. Moving on to yields. What's going on here? We have a very good level of support here at 1.622. Now, if we crack below that, then the floodgates will open and yields will continue to decline all the way to 1.5%. That would be a very solid support to bounce from. So once again, if you share the same outlook as I do, that the dip in the inflationary trade is to buy, and the rip in the de-inflationary trade of technology and high growth is to fade. There are many signals that you have to watch for. We talked about one of them, the purple trend line in the NASDAQ futures chart, and here is another one in the 10-year yield chart. Watch the 1.5 level, because if we go all the way there, that would be a solid point to start buying the dip in energy, financials specifically, and fading the rip in technology. Moving on to the TLT. Once again, we talked about 134.5. We're flying way above it now, and therefore you're seeing yields trending lower. Where is the next resistance here for the TLT? 139. That should be a solid point where the TLT would stop rallying and reverse lower. So we're watching. Here's yet another indicator for you. 139. So we have the purple trend line in the NASDAQ futures, and you have 1.5 in treasury yields. Now you got 139 for the TLT, and you gotta watch carefully how the market would react at these very important levels. Moving on to the VIX. We talked about the VIX yesterday. Every time it dips below 20, I'm buying calls because the volatility is not over yet. The fact that people are not buying puts is not a source to assume that the market will rally higher and there are no dangers ahead, but it is a signal instead of complacency for market participants. And I still believe that we are not out of the woods yet, and the VIX has another large move to come. Moving on to Apple, this is similar to the discussion of the Qs. You have the ping pong game going on between 120 and 125. 120 is the support, 125 is the resistance. The longer you hang out between these two numbers, the center of gravity is 120. The path of least resistance right now is lower, meaning that you're gonna get pulled by 120 if you don't start marching higher, recapturing 125 and turning it into support once again. Moving on to Tesla, the souffle. What's going on here? Fibonacci levels. Once again, I was looking for closing the gap between the two hammers, the green hammer and the red hammer. We did not do that today. We dived lower, but we need to go a little more before closing the gap to see how Tesla would react at that point. If you are a bull, you want to see Tesla bouncing higher after closing the gap. If you are a bear, you want to see Tesla flushing lower after closing the gap, because that would be a confirmation that Tesla will resume crashing once again. And here is the big picture. Are we witnessing the start of a head and shoulder formation in Tesla? Because if that is the case, then that would drive us lower, and the destination will be between 400 and 500. And now, moving on to conclude this video. Once again, it is the battle of choosing which path to drive on in the short term. Is it gonna be, once again, the reinflationary trade of the Dow Jones, financials, energy, industrials, or will it be the growth and momentum names in the NASDAQ? For the time being, the tailwinds are favoring the NASDAQ because we have short covering going on in bonds, driving yields lower, we have rebalancing, and we have the surge of COVID-19 cases. These are all tailwinds that should help the NASDAQ in the short term before we reroute again to the way of the Dow Jones and the reinflationary trade. trade because once again, nothing has changed regarding yields. The dent from COVID today is just delaying the inevitable of the reopening, of course, absent of a black swan event. So the outlook remains the same for me. In the short term, we will see the Nasdaq technology riding higher, meanwhile yields going lower and causing some pain in financials and the rest of the inflationary trade. But once that's over with, we will reverse the course once again of pumping the inflationary trade higher and fading the de-inflationary trade of tech and high momentum names. And therefore, I'm not doing anything this week. No big trades or positions opened this week. Only smaller trades here and there, playing bounces and reversals. But now you have my targets, what to look for in the Nasdaq futures, yields, the 1.5 and the TLT, in addition to Apple 125 and Tesla 679. Of course, the worst outcome right now if the market starts crashing altogether, just like we saw today, because that would tell me that the market's freaking out about something bigger, and it is looking a little further in the horizon, and it is not liking what it's seeing, that the cure is worse than the illness. Inflation is rising higher, and the cure from the Federal Reserve will be raising interest rates. You could play the psychological games of, oh, we're not going to raise rates, we're not thinking about raising interest rates till 2023, but you heard Kaplan today saying 2022, and he refrained from commenting on whether a raise of interest rates in 2021 is possible or not. But we know that this remedy is worse than inflation itself because the economy is not ready for higher interest rates. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.